Welcome to PhillipCapital's Weekly Market Watch. Today, we've invited Mr. Melvin Ho, dealer from Phillip Securities, to discuss if we have a real, believable bull market. So Melvin, the STI has risen drastically by approximately 90% within a span of just about 8 months. Do you think the market has moved way ahead of its economic fundamentals?
It is often difficult to understand the true state of the economy. But what we know is that the market can sometimes be an accurate leading indicator of the economy, and other times an irrational speculator driven by greed and fear. There are two contradicting sayings about the markets. One, the market accurately predicts future economic performance about 6 to 12 months ahead of time, and the other saying, the market can remain irrational longer than you can remain solvent. At present, I think the market is currently displaying symptoms of the latter, being irrationally driven by liquidity on the sidelines and animal spirits of greed and fear, rather than accurately reflecting future economic performance.
What underlying economic fundamentals indicate to you that this bull run is unsustainable?
Firstly, the US consumer, the biggest customer of the world and the main driver of US GDP, is finding it tough to make ends meet with a rapidly increasing unemployment rate in the US. With debts accumulated over the last 3 years and little or no savings, I think consumer spending is going to suffer badly in the years ahead, as the US consumer seeks ways to reduce debt and increase savings for retirement or retrenchment. With the commercial property and residential housing market still in a slump in the US and corporate capacity utilization rates still at relatively high levels, non-performing bad loans could continue to rise in the US. Things will probably worsen once the effects of the government stimulus fade away. This probably explains why banks are not lending in the US, and this lack of credit availability will further impede economic growth. While some say that we can still depend on China in the future, China has its fair share of problems and is perpetuating its own asset bubble by its own government stimulus package. Current high rates of economic growth are sustained only by government spending and not by true consumer demand. So essentially, on the one hand, we have a dead man walking in the US, and if you include Japan and Europe, which have even worse problems, we have 3 dead men walking. And on the other hand, in China, we have another grossly overweight brother. If the China bubble pops, I don't think economic prospects will be pretty.
Are there any indicators that show that we may be experiencing another economic blowout anytime soon?
Yes, I suspect various asset class markets are beginning to show early signs of growing risk aversion and heavy liquidation of risk assets. A particularly worrying sign is seen in the S&P 500 and Aussie dollar charts where a major bearish wedge is formed, indicating that we could see a continuation of the bear market we last experienced from 2008. From an added wave point of view, we could potentially see another mega third or C wave down, similar in length to the bear market in 2008, that could potentially bring the STI to about 800 points in a worst case scenario. Logically speaking, why should we expect the worst financial crisis since the Great Depression to end in just 1 year? Such a massive plunge in market prices is possible if the US and British government goes bankrupt. The breadth indicators that I monitor, which track broad participation by market players, also show me that we have a dangerously over-exuberant market which can crash pretty much anytime soon. Momentum indicators are also showing cracks in the foundations of this current uptrend. Moreover, with all the good economic news and positive outlooks dished out by politicians and analysts all over the world, we also see many contrarian indicators signaling that the end of the bull market may be near.
What would you recommend investors do right now?
The party is too crowded right now, so it's better to leave the party with our winnings while no one's exiting yet. Once the party ends, there will be a panic rush for the exit, and it may not be easy to exit the market. Investors should therefore consider cashing out of profitable positions and wait for further confirmation on the uptrend. I expect extremely strong resistance between 2745 to 2750, so if the market can close strongly above this region, I will assume my original thesis about a bear market is wrong, and would suggest re-entering the stock market with long positions. If the STI closes strongly below 2,600, investors should consider closing or losing positions if any, while short-term traders may want to short the market and cover their positions between 2420 and 2450 as the correction is likely to take place. Whenever in doubt, however, cash is king.
So thank you, Melvin, for your time. That's all we have for you today. Tune in next week for more market updates.